Think of this scenario. A corporation has 10 million shares, each being sold for $100. This would result in a market capitalization of $1 billion. In the financial world, this metric is used to determine the size of a company instead of by sales or total assets, which are traditionally employed. Maybe you are wondering why I am telling you this. This is because today we will discuss two concepts that are closely associated with the idea of market capitalization. Greetings, folks! Financial and Investment Wisdom is back with more financial advice. In today's episode, we will cover everything about small cap stocks and large cap stocks. But first, make sure you clicked the like and subscribe buttons on our channel. Before we go into the details of small cap stocks and large cap stocks, let's define market capitalization first. The market capitalization of a firm indicates the company's scale, which is something that most investors are concerned about. This is because it generally draws attention to various essential qualities of an organization, including its risk management practices. Evaluating the value of a firm is a critical activity that is frequently hard to accomplish in a timely and precise manner. When it comes to publicly listed enterprises, market capitalization is a quick and straightforward approach to evaluating their worth by projecting what the market believes they are worth. In such a circumstance, multiply the share price by the number of shares that are currently available. Following our discussion of market capitalization, we can now describe large and small cap stocks. However, before we get into this, let us have a look at some of the basics. The terms large cap and small cap pertain to a firm's market capitalization, which is the total dollar market value of all of the company's current and limited shares of stock. Large caps have a higher market capitalization than small caps. Large cap stocks are those issued by very large corporations, and small cap stocks are those issued by smaller public corporations. Although both forms of stocks reflect an ownership stake in a company, the disparity in size between the corporations that produce them implies that they might behave significantly different in your portfolio. Many people are under the impression that they can only make money by investing in large cap companies, so labels like these can be deceiving. Moreover, this could not be further from the truth, especially in the present times. If you do not recognize how large small cap stocks have grown, you will lose out on some great investment possibilities in the future. Even though small cap businesses are regarded as ideal investments because of their low valuations and ability to expand into large cap stocks, the view of what constitutes a small cap stock has evolved throughout time. One example is that what was once called a large capitalization stock in 1980 is now regarded as a small cap stock. Now it is time for us to take a closer look at the specifics to gain a better understanding of how these two principles work. Small cap stocks feature fewer publicly traded shares than mid-cap or large-cap corporations. These firms account for between $300 million and $2 billion of the total monetary value of all shareholdings, including shares held by various investors, institutional investors, and company insiders. These tiny businesses may be newer and/or cater to specialist markets or new sectors. Considering their longevity, the industries they serve, and overall scale, these businesses are regarded as higher risk investments. When the economy slows down, smaller enterprises with less resources are more vulnerable. Companies with a smaller market capitalization will issue fewer shares to the public. These equities may therefore be thinly traded, resulting in prolonged processing times for their trades. On the other hand, individual investors have a distinct competitive edge over institutional investors in the small cap market. Small cap deals do not attract the attention of institutional investors as regularly as larger cap offerings do because they buy a vast block of shares. Assuming they did, they might find themselves in the position of having controlling shares in these smaller companies. Small cap companies continue to struggle caused by a lack of liquidity, which is particularly frustrating for investors who take satisfaction in developing their portfolios based on diversification. As a result, small cap shareholders may have difficulty unloading their shares. Investors may notice that it takes more time to acquire or sell a specific asset with a low daily trading volume, and there is less liquidity in the marketplace. Additionally, small-cap fund managers close their funds to new investors when their assets under management fall below a certain level. Large-cap stocks, often referred to as large caps, are equities that float on the stock market for firms with a market value of at least $10 billion. These enormous corporations have often been in existence for a lengthy period of time and are also referred to as blue-chip stocks, or businesses having a history of stable profitability, excellent reputations, and strong profitability. When markets are unstable, large-cap companies tend to be less risky because investors flock to reliability and quality and become much more risk-averse. Investment in large-cap firms may not always result in massive profits in a short amount of time. However, these firms often compensate shareholders with a constant increase in the value of their shares and stock dividends over the long term. Although it is true that companies like these generally perform well enough and give investors safe profits, you cannot use this as a general rule for all large-cap stocks. Due to the perceived high value of large-cap stocks, most investors believe that they are less risky than other, smaller equities. There have been a number of instances in financial history that demonstrate the reverse. It serves to indicate that the larger they are, the more difficult it is for them if they fall. Hey folks, thanks for sticking with us as we go into greater depth to help you better grasp the relevance of these two ideas. We hope you are learning something new from this video. Before we go any further, please like and share this video. But aside from the fact that they are different in size, age, and the market they serve, what do you think are the main differences between them? For starters, large-cap companies have distinct leverage in areas of stability and research coverage. There is a large and influential following for large-cap offers, and investors may analyze plenty of financial information about the companies they are investing in, as well as unbiased research and market statistics. Furthermore, large capitalization companies tend to be more efficient in the market and trade at values that represent the underlying company. Moreover, they trade at a larger quantity than their smaller counterparts. On the other hand, small-cap stocks are more unstable and riskier in terms of investments than large-cap equities. Companies with a small market capitalization typically have less access to capital and, in general, fewer financial resources than larger corporations. For small and medium-sized enterprises, obtaining sufficient capital to merge cash flow needs, help finance market growth endeavors, or incur significant capital expenses is challenging. During periods of economic downturn, this dilemma can become much more severe for small-cap enterprises. However, there are compelling arguments in favor of investing in small capitalization stocks, even with the added risk they pose. One advantage is that it is simpler for smaller firms to attain a proportionately large growth rate. Furthermore, because a small, intimate management team frequently runs smaller businesses, they are better capable of adjusting to changing market conditions in a manner similar to how it is quicker for a small boat to shift direction than for a massive ship to be doing the same thing. Similarly, large-cap stocks are not necessarily the best investment. Established businesses may have less potential for expansion and may not be as responsive to shifting economic conditions. Indeed, numerous huge corporations have been thrown into chaos and have fallen out of favor with the public at large. A large capitalization company does not necessarily imply a good investment opportunity. You must still conduct additional research, which includes looking into other smaller companies that can serve as a solid foundation for your whole investing portfolio. In a nutshell, the primary distinction between large-cap and small-cap firm stocks is their market capitalization. Unlike small-cap stocks, which represent ownership in smaller organizations that are still in the early stages of growth and expansion, large-cap stocks are issued by larger, more established businesses. It is also important to remember that classifications like huge and small are subjective and relative, and that they are vulnerable to change throughout time. Constantly evaluate your options and select the kind of equity that best suits your needs. What are your thoughts about our video for today? Share your ideas with us in the comment section below. For more helpful financial advice, check out our YouTube channel, and if you enjoyed the video, please do not forget to like and share. Thank you for watching. This is Financial and Investment Wisdom, and we will see you again next time.